Oh my God, Quasar Works Live. Hello, hello, hello. I've got Alan Ellman with me. If you like options, you understand options, you're going to learn even farther what options really mean. And Alan, how are you, man?
Doing great. Ready for this interview, Steve. Looking
I know
forward.
you are. And you're going to be at the Money Show pretty soon, right?
Yeah, the 16th to the 18th, I'm doing a keynote presentation and two workshops. So I'll be keeping pretty busy.
That's the best part. I mean, you when you go to the Money Show and you go to these events, and people do listen to you because you're explaining options on a level that they need to understand, so they get. And I love the one today. It's called "Unlocking the Mystery of Longer Dated Calls, Options, and Delta." So explain all that to the people. I'm gonna let you go. Because I know you're the man. I'm gonna get out of your hair because I know you're. If I stay too long in your hair, might turn as gray as yours, man. I don't know, but I love this. That's when you know your stuff. So here we go. I'm gonna get out of your hair. Here we go.
Thanks, Steve. Okay, so for everybody out there that has a portfolio of stocks, and I'm sure that's most of you, you've been generating income because of share appreciation, probably also because of dividend generation. But these very same shares that have been appreciating and generating dividends can also be leveraged for third income stream by renting out the stocks, by selling call options and renting out the stocks on a short-term basis. Now, many of you have had these stocks for a long time, perhaps in non-sheltered accounts. And if you generate this third income stream into your portfolio, you also don't want those shares sold, possibly because of some negative capital gains tax issues if you sell your shares of a low cost basis. Possibly because you've developed a relationship with these shares and you love having them and you love having the dividend income. Whatever the reason is, you're willing to rent them out, but you don't want them sold. Now, what if there was a metric out there that could tell you the risk inherent in selling that option, the risk of exercise of the option, and therefore sale of the shares, which you don't want? And there is a metric, there's actually a couple, but what I'm going to talk about today is delta. And one of the three definitions of delta is the approximate probability of the option expiring in the money and subject to exercise and subject to sale. So if we're going to sell an option on shares that we don't want sold, then we know we're going to want to have a low delta option. And that information is readily available in our option chains. Every broker has option chains. Or you can go to free sites like cboe.com or finance.yahoo.com, and you'll have option chain information. And inherent in that option chain typically are delta stats. So just to review, delta is the approximate probability of expiring in the money and subject to exercise, which in this discussion is something that we don't want. Now, a lot of option sellers looking to generate this third income stream are wondering whether or not, if we go out further in time, how that would impact the delta or the risk of exercise. So let's move on to the next slide now. And we're going to talk about how will delta change as we go out in time. Okay, so if we're analyzing delta to determine the risk of exercise or the risk of sale of our stocks, then from an option chain, then we also need to know what is delta going to do as we go further out in time. So let me ask you, the audience, what do you think is going to happen to delta as you go out in time? Do you think delta is going to go down? The risk of exercise is going to become less? Who thinks that? What do you bet? What do you think? Is it possible that the delta will go up? That the risk of exercise will become even higher as you go out in time? What do you think? Maybe you think something else. And what is that? Okay, so again, does it make sense to go further out in time, measuring the delta metric or the risk of exercise? Let's go to the next slide, Steve. And we're going to show you now a real life example with one of my favorite stocks and probably yours too, Apple, listed on NASDAQ. AAPL is the ticker. on September 4th, about a month ago when I made these slides, Apple was trading at 238.03. So here's what we're going to do. We're going to check the option chain data on that date, on 9/4, and we're going to look at the 1 month and 6 month option chains. And we're going to look at two types of call strikes. The in-the-money call strike, where we're agreeing to sell our shares at a lower price than current market value. And we're going to look at an out-of-the-money strike, where we're willing to sell our shares at a higher price than current market value. So with Apple trading at 238.03, we're going to look at the in-the-money 225 strike, and we're going to look at the out-of-the-money 250 strike. And then we're going to do the same thing going 6 months out so we can see what happens to Delta as we go out further in time. What is our risk of exercise as we go out further in time? How many of you said Delta is going to go up? How many of you said Delta is going to go down? How many of you said, well, I think it's going to be something else? Well, we're going to find out. All right, Steve, let's go to the next slide now. Now we're looking at an option chain, the 1 month option chain for Apple on 9/4/25. And you could see in the red oval on the top right, this is for the October 3rd, 25 expiration. So about a month out, right? And I told you we're going to look at the in-the-money 225 or the out-of-the-money 250. Now I want you to look in that Delta column in the middle of the screenshot now. And let's look at the delta for the 225 strike. And you can see the delta there is 80.88. So let's call it 81% delta, which means there's an approximate probability of exercise, 81%. That's our risk. Now, since we're selling options on shares that we don't want to be subject to exercise, this would not be a good choice. I mean, the premium, the bid price of $16 might be enticing, but if one of the requirements is share retention, we're going to stay away from the in-the-money 225 strike. But remember now, we also want to measure what's going to happen if we go out further in time. And we'll show you that in the next slide. So keep in mind that the in-the-money strike has a delta or risk of exercise of 81%. Now, let's go down to the 250 out of the money strike in the brown row towards the bottom. Now you could see that the 250 out of the money strike had a delta of 24%. That means there's an approximate 24% probability of exercise or having our shares subject to exercise by expiration. Now remember, we don't want our shares sold. So that becomes a 76% probability of success. Now there's one more factor here. We can always buy back the option before expiration. So even if the price of Apple moves from 238.03 to above the 250 strike by expiration, we can always buy it back. So the real risk is less than 1%. But without exit strategy intervention, the risk is 24%. Okay, so obviously, if we're going to use our portfolio of shares that we've owned for a long time that we're looking to generate a third income stream, we are going to favor out of the money strikes, agreeing to sell our shares at a much higher price than they're currently trading for. So before we go to the next slide and look at that 6 month expiration, let me just summarize now. The risk of the 225 expiring in the money is 81%. The risk of the 250 out of the money strike expiring in the money is only 24%. Now, we're going to see what happens to Delta as we go out 6 months. Steve, next slide, please. Okay, here we go. Now, let's look at that 225 in the money strike, the yellow row, and look at the Delta. The Delta went from 81% down to 69.7%. So the Delta went down for the in the money strike. And we'll discuss why in a moment. But for those of you that said, as you go out further in time, Delta is going to increase, you're already wrong. Now, let's look at the 250 strike. And the 250 strike, going out 6 months, the Delta went from 24%, it doubled to 49%. So twice as much risk of exercise going from 1 month out to 6 months. So for those of you who said delta is going to go down, you're also wrong, because for the in the money, the delta went down. For the out of the money, the delta went up. So let's see if we can make some sense of this and move on to the next slide, Steve. So we're comparing the in the money and the out of the money deltas. Okay, in the money, 225 strike. As we went out in time, the delta went from 80% down to 69%, almost 70%. Well, that's a decrease of about 10%. So why did that happen? Well, it started in the money, right? So the starting point was exercise. It's going to get exercised. But if you go out 6 months, you're giving Apple an opportunity to move down below that in the money strike and then ultimately become out of the money. But look, the decrease was 10% and still at almost 70%. So the takeaway here is, if you want to keep your shares, you're never going to use an in the money strike. Even though the delta or the risk of exercise is going to decline, it's not going to decline enough to make it safe and not subject to exercise. It's almost always going to be more than 50% when you're using an in the money strike. All right, that's one takeaway. Now let's look at that out of the money strike where the delta doubled, right? So for the 250 strike, it went from 24% to 49%. That is a big difference. And why did that happen? Well, think about this. Apple starting out at 238. Over 6 months, there is ample opportunity for Apple to go from 238 to above that 250 strike, thereby rendering that 250 strike now in the money and subject to exercise. So the probability of expiring in the money will increase over time for out of the money strikes. So for in the money strikes, delta will decrease, but not enough to make your trade safe. And for out of the money strikes, over time, delta will increase, creating greater risk, which we don't want. Next slide, please, Steve. Let's see if we could summarize now. So as we use longer dated options, delta will decrease for in the money strikes and increase for out of the money strikes. So at the beginning, we said, how many of you think delta goes up? For those of you who did, partial credit, because it goes up for out of the money, but it goes down for in the money. For those that said delta goes down, partial credit. Now, if you said something else, and if you didn't specify, I'm only going to give you partial credit for that. So what's the takeaway here, Steve? Look, if you have a portfolio of stocks that have been generating two income streams for you, one, share appreciation, the other, dividend income, and you want a third income stream, but you want to do it in a conservative, low-risk manner. In other words, you want your cake and eat it too. You want to generate income, but you don't want to sell your shares. This is what this presentation tells you. Number one, only go out of the money. Number two, prefer to use shorter dated options, because longer dated options will increase in delta over time. We don't want that. And then you have the metric of delta, which will actually quantify the amount of risk you're taking in your trade, and you can determine, based on your own personal risk tolerance, how much risk you're willing to incur. Now, if you're asking me, and I was doing this with shares that I did not want to sell, I would look for deltas of 10 or lower. And remember, even though you're taking much less risk, the premiums will be lower, but significant nonetheless, because I could tell you this, I've done studies on this, I've written articles, done presentations. If you're using 10 delta options, short dated options, your annualized returns will increase or become greater than the appreciation you've been getting up to now by 4 to 15% annualized. And that is significant, because if your portfolio is generating somewhere between 8 and 12% a year, and now you're tacking on another 4 to 15%, you've got to consider that significant, and yet it's still done in a very, very low risk manner. So, Steve, that's pretty much what I have to say today. I was thinking that your members, I know most of them probably have portfolios of stocks that they've had for years, maybe even decades, and they've been enjoying the appreciation. But now I'm offering a third income stream in a low risk, conservative manner for their consideration.
Yeah, and I think that all of us with big portfolios, and we want to make sure that we're also protecting them with long dated calls too, and making sure that we understand how to put those collars on them too. I think a lot of people don't really understand that as well. And when you're looking at long dated calls, in your case here, you need to understand time and the crunch and the Greeks around it, and Delta being one of the main ones there, players too. So you need
Yeah,
to understand that.
yeah, if you're doing call, you see, everything depends on whether or not you want. It's critical in your strategy to retain the shares. For me, my portfolio turns over 20 to 80% a month. I could care less. I don't care about the stock at all. I just care about the cash that stock I'm leveraging will generate into my account. But what I referenced today was really for people that have these long-term buy and hold portfolios and non-sheltered accounts, low cost basis. They don't want to pay capital gains if the option is exercised. And so in that case, we would favor the low delta, short dated options, and so on. But when you mentioned something about the collar where you add a protective put to the trade, perhaps we could talk about that at a future discussion. And that certainly is a way to protect your
And we want to
portfolio.
make sure everybody get a hold of you too, Alan. It's the bluecollarinvestor.com. Make sure you go to the site, check him out. I mean, listen, I know Alan personally for a long time, and I can tell you he's a good guy, and he'll actually answer your emails. I think a lot of people, I always say this all the time, that a lot of times people can't get to us, or they want to chat with us, they can't get to us. They can. Alan, well, you'll actually answer their emails, right?
Absolutely. Within one business day. We always do.
One
Usually
business.
the same day.
And I will see you right back here in about 7 business days. Of course, I'll talk to you before then. But Alan, we'll see you next week, my man.
Thanks, Steve. Take care.